We're back with Bobby and JJ Radio. Now, this show is very, very special to me. It's going to start our investor series, which is going to be a big part of our show, Bobby and JJ Radio. Our first guests, or actually both of our guests, are these powerhouse owners of great businesses. It's another special show because I got my man, my son, my namesake Trey in the studio. Everyone say hi to Trey.
What's up, Trey?
Hey, Trey. All right. So our first guest is Ed Guerrero. He is a San Antonio native, which is pretty rare. He's graduated from UTSA in 1987, beep beep, and he had a double degree accounting and finance, which I'm sure got all the ladies. And he's been a CPA since 1989.
Got or gets?
He gets and got. It's all been done. Now, he has the fastest growing CPA office in San Antonio. He's growing at about a 65% rate every year. He has helped almost 4,000 clients, and he's been a personal real estate investor for 20 years.
Greatest CPA, best CPA
of all time.
I feel better every time I go in there.
Yeah.
Yeah, that you should. That's what I tell people.
Yeah, and Ed is the one-stop shop. If you're a business owner, if you're a real estate agent, if you're an investor, if you own a home, you got to talk to Ed. You have to talk to Ed Guerrero. Now, Ed, we're going to talk about for investors, what are some things that they need to consider for tax purposes?
Well, thanks, Bobby and JJ. I'm glad to be here. One thing I always tell my taxpayers is first you got to know the slogan.
Sure.
Go see Ed. So that slogan is always go see it, okay?
That's it.
So I don't know about the ladies, but I know about the taxes, okay? So, the bottom line is that with taxes, the most critical point in time when to prepare for your taxes and when to start thinking about your taxes is today, the next month, then the following month, because the truth is most taxpayers, they think about taxes when? January, February, March. Well, that's too late because the bottom line is that you just let go of the opportunity to minimize your taxes by implementing tax strategies. Right. And we'll get a little bit deeper in the tax strategies in a minute, but the component is to understand today is the day that you have to start planning your taxes and understand what your tax liability is going to be.
Sure.
Can you talk a little bit about 401k withdrawals?
Absolutely. I don't like them because it costs a tax issue. But if you're talking about how to utilize your money in the best way, again, if you just withdraw your money without considering the tax implication, you'll be surprised in January, February, March.
Right.
However, what we do is we set up individuals that have a 401k or an IRA and to utilize it to purchase any type of investment, real estate. We tell them, hey, let's create a separate company for you and let's roll it into a solo 401k.
Sure.
And as a solo 401k, as the owner of the company, you're able to then borrow against the money and tax-free. There's no taxation related to that borrowing of the money, and then utilize it to purchase a real estate.
So let me break this down for the listener, even myself. So you're saying that if you need to come up with, let's say, a down payment, let's say you're a buyer, most people think they just have to save it up the old-fashioned way, but you can actually borrow against your 401k, right?
Absolutely. And as long as you're borrowing against the 401k, tax-free, no taxation involved.
So is there any penalties to it?
There's no penalties as long as you're paying back the 401k. The key is you got to think about the 401k is that when you do withdraw that money, you could have an equivalent tax of not only the 10% penalty,
sure,
but the additional taxes on your ordinary income. So normally most people have an equivalent tax rate of about 30%.
Is there any limit to pulling out of your 401k?
There will be a borrowing limit of $50,000 as you borrow against your 401k, but you can use it as a savings account as to replenish the money back. As once you do your down payment, you can put more money back so that you can get below the $50,000 and continually cycle those down payments for additional purchases.
And so what are some other methods that you see that people are kind of parlaying their current investments and allowing them to, diversify into the real estate game?
Well, what I see a lot of is self-directed IRAs.
Okay.
So that's where you'll get a third-party trustee to set up the self-direct and file the additional paperwork that is required. And self-direct means you take those funds and you direct them to, say, a real estate purchase,
right,
and then that real estate is holding, that self-directed fund is holding that real estate, and any profits and expenses is run through that fund, and net income will come back to the self-directed fund.
So if you're just tuning in, we're talking to Ed Guerrero from Guerrero CPA. He's given us a lot of information as far as taking current investments that most Americans have and using them to parlay or kind of diversify into the real estate market. Now, Ed, IRAs, they get a little, they're a little tricky. I thought it meant Irish Republican Army for a long time, and then I realized I was completely wrong. But let's transition to why is real estate so good for someone personal? Like, what are the benefits of buying a house for just a regular person that is going to purchase their first or second home?
Well, Bobby, the biggest tax break that the taxpayer has for real estate is their property taxes and their interest.
Okay.
And obviously, it's a solid investment.
Sure.
And so through the life of their holding of this property, they're able to take those tax deductions and continue to write them off and lower their tax payment. So, the first step I always tell my taxpayers is, first, do you own a home? Because if you're missing out on that tax deduction, you're giving Uncle Sam, which,
right,
we like to give him as much or as little as we can.
So you're confusing my son Trey here, because my brother's name is Sam, and so when you say Uncle Sam, it sounds like it's a bad thing. But you're talking about the United States government, right?
Right.
So if you're a renter, you're saying that you're not taking advantage of like writing off the interest that people pay. And when they first get a loan, the first 3 years, almost all interest that they're paying.
That is correct.
And so what you're saying is that if you're just sitting around renting, you might, instead of home ownership gives you these deductions that will actually like lower your tax liability.
Absolutely.
Okay.
It lowers your tax liability, and you can have you can add to that those deductions go on a Schedule A, itemized deduction.
Sure.
And we can add to contributions. We can add to other deductions to maximize your Schedule A,
right,
thus lowering your tax write-offs and your tax liability.
So it's almost like you make less that year.
Absolutely.
Okay. What are the benefits for selling?
Well, that's the beauty of owning a home. Your primary homestead, if you own your primary homestead, you have if you live in the primary homestead for 2 out of the last 5 years, you have the ability to do an election that gives you a $250,000 exclusion on capital gains. If you're married, it gives you up to $500,000 exclusion. So what that means is, if you have a capital gain that's less than $500,000, it is all tax-free. Whereas if you sell the house and you have higher capital gains than $500,000, then the difference is what you're paying on.
So you're saying that if someone sells a house and they're taking out what we call equity, which is the net profit, right?
Right.
And as long as if they're married, so me, not Bob, but my Bob $250,000,
sure,
me $500,000. If I can make up to $500,000, and that amount cannot be taxed.
It's called tax-free.
My
tax
brother
exclusion.
Sam. Yeah,
yes.
I gotcha.
So that's a great way to use your equity,
sure,
and use your money to then multiply.
Because that can happen with stocks or any other kind of thing. It's very rare for you to get that kind of exclusion with,
absolutely,
with a net profit like that. Okay.
And that's the beauty about real estate.
Sure.
Now, Ed, talking to the investors now, what are some of the benefits of I guess, tax benefits in purchasing a home?
Well, we were talking earlier, and there are certain types of investors. You hear cash flow and Robert Kiyosaki talking about cash flow and let's bring in some more money. And
sure,
and then there's the investors that I deal with. I want more write-offs, and I don't need more money today, but I need more money in the next 10 to 20 years. Well, we have a strategy where we get them to participate in investing in real estate, and we're having the write-offs. And the biggest write-offs in real estate are the depreciation of the real estate. So
it's not the interest; it's the depreciation.
So you got interest, taxes, depreciation, and maybe rehab and expenses,
sure,
and repair and maintenance, and other expenses that you can add to that. So now that you have real estate, it gives you a lot more deductions as an investor.
So we're always talking about benefits in buying a home, an investment home. Is there any benefits in selling one of your investment homes?
There is. I like to call it a deferred tax benefit. If you sell, there's different ways to execute the transaction. I always tell the taxpayers, if the best way is to hold it for a year or longer, because then we participate in long-term capital gains rather than short-term. The difference in tax rate is 15% for long-term capital gains versus ordinary tax rate for short-term, which could be 10, 15, 20, 30%.
Wow.
So it's a big deal. And what I tell folks is maybe a good strategy is, as an investor, if you know you're going to sell it, well, why don't you do an owner finance for the first year, and then right after the 12-month, let's go ahead and totally sell it. And we just got past the higher tax gain calculation.
So for people who really don't, it's because a lot of this is going over my head, and I'm in real estate. So
sorry about that.
So definitely,
it's in English, so it's going to freak them out.
In selling a home in less than 12 months, you definitely get taxed at a higher rate, much higher rate.
It's a potential higher rate.
Unless they went to go see Ed, because Ed would definitely find a way.
Give you a strategy.
He has a strategy.
We would find strategies to minimize that taxes, and that's the key.
Now, real quick, and if you're just tuning in, we're speaking with the CPA juggernaut, Ed Guerrero from Guerrero CPA, and he's giving us a bunch of tax strategies for investors and homeowners. Now, back to the investors buying. So you're saying that for some of your more seasoned investors, they're looking to, like you said, they don't need that money today, right? So, they have a good sized income, and, everyone makes their money between the ages of 35 to 55 or so.
Yeah. That is correct.
So, and during that time, that period, that 20 years, you're hustling and you're bustling and you're making the most money, but sometimes you want to take that money and make it more long term. And so you go and find an investment with maybe some, like my man here, Nathan Crone, and you can kind of hold it and have it as like an annuity. I know that's not the best word to use, but kind of have it as an annuity where you take it off your plate now, but it's a benefit later.
Absolutely. And you're choosing the right word. It is like an annuity.
Okay, cool.
It's other people's money, building your equity.
Sure.
And your equity is your annuity. However, we haven't talked about the investor is getting a tax flow. So obviously, it's like I did a calculation just the other day.
Okay.
I did it with one of my taxpayers. They said, well, should we still keep this investment because it's losing money and we're writing off losses? And I said, okay, let me figure out your taxes without it. So when I went and took the real estate without the tax return, it bumped up their tax liability up $15,000.
Okay.
So they actually, by holding their real estate at a net loss, they actually are getting a tax flow of $15,000.
Wow.
And they don't see it that way, but when they see it inside their taxes, then they go, okay, now it's a good thing.
Yeah.
And now the couple stop fighting because one's saying sell it, the other one's saying hold it.
Yeah.
And it's a better thing.
Yeah, but the numbers
they want to go see Ed, right?
Yeah, they had to go see Ed.
And that's when I become the mediator for the family.
I got you. You've done it with me and my wife for sure.
Absolutely.
Yeah. So Ed, let's talk a little bit about 1031 exchange transactions.
Absolutely. When you're an investor and you want to, if you have to sell property and you're going to roll it, it's a good way to roll property. So like-kind exchanges are always what you're talking about is 1031. So the bottom line is that you have to prepare, you have to plan, you have to get the real estate folks involved in the title company and make sure that, first you already identified the property because you have 45 days from the date of the closing of the property to identify the property, and then you have another 180 days to go acquire the property.
So you're saying that...
So there's a timetable that you got to abide by, or else Mr. Uncle Sam says, hey, not this Sam, but the Uncle Sam says, hey, I got you,
So just for the layman's terms, because it's a little bit more...
For Bobby,
yeah. Let's just call it Bobby's terms. So 1031 exchanges when you get some properties and you sell them, and then you have to go through this long series of stuff that you can ask Ed about, and then go and kind of exchange them for some other annuities or properties.
Absolutely.
Okay.
And it's called deferring your capital gains, because every property when you sell, you have a capital gain calculation.
So you're taking that money and purchasing something else in a certain time so you don't get taxed heavily on it.
Absolutely.
Ed,
and you're getting deferred on that.
Ed, this is some awesome information. I know your time is very valuable. We want to thank you so much for coming on, and I know that you're giving something away here on the show. Anyone that wants to get a free tax analysis, they can contact you at 210-490-7100. 490-7100. That's
Absolutely.
210-490-7100. Or go to GuerreroCPA.com and you'll look at their last 2 taxes and you'll make sure that they've done everything right. Because if they haven't talked to Ed, they got to talk to Ed right now.
That's absolutely. So remember, go see Ed.
All right.